Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this podcast will make you a smarter investor and a better leader. So I have 1 minute to rifle through our stocks of the day instead of stock of the day. I'm looking at the Magnificent Seven weakness. Of course, this is shares of Apple, Meta, Nvidia, Tesla, you name it. Seeing these stocks really under pressure except Meta. Tesla is the worst performer. Meta is the outperformer. Two reasons I'm hearing on why this trade is starting to break down, at least here in February. First up, CapEx. Meta, Microsoft, Amazon, and Google are set to spend $325 billion this year on CapEx. That's about a 46% year-over-year increase. Shout out to Yahoo Finance's Laura Bratton for digging up that number. Street concerned about how margins are going to pan out, how cash flow is going to pan out. So there's that concern. And the next two, shout out Adam Parker for this fun fact. The forward P of the Mag 7 is at a 42% premium to the rest of the S&P 500. So the street may be getting worried about valuation, but put those two things together, and that's where you're seeing this sell-off here. Tesla, that sell-off. I have a new article on Yahoo Finance breaking down that one. It's a real ugly show. All right, let's get to our feature interview today. That is Morgan Stanley Managing Director Brian Nowak. Brian, good to see you. Big fan of your work. I digest it literally daily, so good stuff.
Thanks, Brian. Thanks for having me.
So I love what you wrote about robotics in Amazon, but I got to ask you a couple questions off the top, just market-oriented. How come Amazon stock hasn't sold off after that earnings report? They come on the call, say we're going to spend $104 billion on CapEx this year. I think that surprised everybody. I think the street was at what, like 80 to 85 billion?
Yep. Well, I think part of it in this current tape is we are finding that the companies that are being rewarded by investors are the ones that are either A, showing the most early signs of tangible incremental ROIC from all of their GPU-enabled CapEx or GPU-related CapEx and Gen AI investments, like we're seeing with Meta. Or with Amazon, it's the core business is chugging along nicely. We're seeing retail profitability improve, and there are a lot of call options that we think are going to play out over the next 2 years from this Gen AI related CapEx. There's two specifically that I would call out that I would say are causing investors to say, we're going to buy Amazon and support it at these levels. The first one is Amazon Web Services and AWS. The number in the fourth quarter was essentially in line with expectations, despite the fact that, like Azure and GCP, AWS is facing near-term capacity constraints. And so we think that as we go over the course of 2025, AWS is likely to accelerate, which is one good signal around real incremental ROIC related to Gen AI. The second opportunity, and I think the largest misunderstood opportunity when it comes to Amazon, is all of their GPU-related and Gen AI investments that they're making on the retail business. I thought the company did a really good job at laying out all the improvements they're making to their suggestion algorithms, to their advertising products, their new diffusion models, the way in which their inventory management is getting better, the way in which they're integrating robots, which I know we're going to talk about, into their overall logistics network. And essentially, I think that the market is supporting Amazon despite that CapEx guide up because there is so much optionality to come from these GPU-related investments on both AWS and retail that the stock isn't that expensive relative to growth if they can hit current street numbers. And if you can actually get some real torque to estimates from some of the fruits of these investments coming through, then the stock can really work and it starts to look very inexpensive relative to growth.
Why? You mentioned a couple catalysts. First, I've been surprised by the margin expansion on Amazon. I think in that quarter, that was impressive off the jump. You mentioned a couple of near-term catalysts. They're launching a rocket soon, and then I got this invite too in 2 weeks. Some Alexa product updates. Which one are you most excited about?
I'd say probably the Alexa updates. I think as we sort of think about the next generation of personal agents or digital assistants, Amazon is fully going to, we think, push out a next generation set of devices and essentially an Alexa agent. It may be called Rufus. That's the new agent that they have. It could be called Rufus
Why?
at the time.
No, not Rufus.
Yeah, I know. Alexa may become Rufus.
Don't you have any influence with that management team there, Brian? Like, change the name. Oh my God, come on.
Yeah.
But isn't Alexa already AI? So what can they release? How will that Rufus agent help me?
Yeah, well, it essentially comes down to the technology that's enabled by neural networks, which is what sort of has powered the previous editions of Alexa, versus large language models and multimodal models, where in essence, you could have more devices come out of Amazon that are going to be powered by large language models that you could talk to, that could understand pictures that you take, that could understand videos that you take.
That's creepy.
So you could have a situation where, we're going to get to 2026 and Amazon through Rufus or Alexa and their devices is going to be competing to be your personal digital assistant. Google through Gemini will be doing the same, as will OpenAI, as will Perplexity.
Do I pay for Rufus?
We think so. We think as of right now, the initial product that's going to come out, the next gen Alexa Rufus product, it probably is going to be a paid subscription product. The question I think will it be a small upcharge on top of Prime, or will it be a real material number on a monthly basis? That's what we don't know yet. How are they going to bundle it into Prime? But we do think, like the premium products at Google Gemini and OpenAI and Perplexity, we do think for now it's going to stay behind a subscription paywall, just because the cost of compute of powering Rufus and powering a multimodal digital assistant is still quite high. So I think it's going to be part of the
I hear these things and I'm like, how can you dump Mag 7 stocks? I mean, these are just the companies finding new ways to print money, right?
No, that's right. I think what we're seeing is we're seeing the big get bigger in essence, and what's happening is these leading companies, they have the largest user bases, they have the most recurring user bases, so the amount of first-party data that they have is on top of the globe. They also have a very high frequency and refresh rate of their data, which matters. So people, as an example, people are interacting with Amazon, Google, Facebook daily, and they're spending multiple minutes on the platforms every day. So they have broad reach, they have high frequency and data retention of that reach, so a lot of minutes per day. And then because they have so much cash on their balance sheets, they're able to reinvest aggressively and build out next generation capabilities to better leverage that leading reach, that leading data, and ultimately make the platforms even more differentiated. I think that when we sort of go back to the last couple of years of what's changed with large language models, one of the things that's important to always keep in mind is the value of the outputs and the quality of the outputs that comes out of these models and applications on these models is really directly linked to the data that underlies it all. And so the fact that these companies have such broad and differentiated first-party data, and they're investing so aggressively, to your point, over $300 billion in CapEx across the big four companies this year.
Are they spending too much though?
No, we don't think so. We think this is actually a period where they should press and spend as much as they can, because this is an early situation where they want to continue to stay ahead of global competitors, in particular with what we saw with DeepSeek a couple weeks ago. It's important that we have the US tech companies continue to invest to stay at the cutting edge of what comes with large language models, both large and small language models, and then applications that are built on top of those as we think about inference and as we think about all the digital benefits that are going to diffuse throughout the economy from all the next generation applications.
I'm going to save your robot work to the second half of this. So let me just quickly jump to Meta, because I think the Yahoo Finance community needs a little more insight on this record run we're seeing in Meta. Is it what Zuck has done to get closer to the president, or is it something fundamentally different with Meta?
I think it's fundamental execution. So if we step back over the last few years of what's changed at Meta, if we go back a few years ago, Apple made some changes that essentially cut off one of Meta's most important signals that they were using in proving ad attribution, targeting, and essentially helping the ad business differentiate. At that point, Meta made the decision to press harder on GPU investments and start to move their data centers and their algorithms over to GPUs. This was before GPT even existed. So they started moving over to GPU-enabled machine learning post the Apple incident before anyone else. Then we roll into GPT and the larger focus on large language models and these capabilities. And because of the fact that Meta had already started building up larger clusters and data centers with GPUs, they were able to move a little bit faster and essentially push more of their user base, engagement, and ad tools onto these next generation GPU enabled capabilities. And the benefits of that have been, we've seen they're able to analyze more of their data on a real-time basis. They are analyzing more instances of when you scroll up and down the feed, where do you stop, where do you stall, where do you scroll faster, and they are using more data points to essentially improve the relevancy of all the content that their users see by day part. And then they're able to also take that data and use it on the advertising side and determine, are you more likely, Brian, to click on ads in the morning when you're catching up from the night's news? Or are you more likely to click on ads in the evening when you're scrolling through your daily catch-up or your sports or wherever you see in Instagram? And they are inserting ads that are by day part, by consumption, based on your behavior.
I gotta get off this crap. I wish I could just delete my account right now, Brian. This is ridiculous. This is totally ridiculous.
You're being pushed all these items that probably have utility for you, and you probably like the ads. You don't even know it.
Yeah, no.
But essentially, what's happened is the reason why this stock continues to be rewarded by investors is because I go back to that overarching theme of the market is rewarding companies that are really showing incremental ROIC and revenue from GPU-enabled investments. And they're about a year plus ahead of everybody else in what they've been showing. And so when you think through engagement on the platform accelerating last year, these are numbers where we think users spend 30 to 45 minutes per user per day on Instagram and Big Blue Facebook. Those numbers in some cases grew 8 to 10% last year. The ad performance improved. Click-through rates and return on advertising improved. The revenue has accelerated off of a very large base. And essentially the market is saying they are improving their core business, which makes us feel better about durability of growth. And then there are a lot of call options that the market is starting to now start to price in and get excited about because of new products that could come from Gen AI.
Sure.
Products such as Meta AI and the idea that Meta at some point could look to get into more of a search-like product, new business agents, the WhatsApp messaging opportunity, the entire wearables product when we think through what they're building out with Orion and Ray-Bans. And so Meta is being rewarded because they're showing the ROIC from the CapEx, and similar to Amazon, they do have a lot of call options to come. And that's why when we're looking for Gen AI winners, Meta continues to outperform for now.
All right, hang with us, Brian. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, having a great chat here on Amazon, Magnificent 7 stocks with Brian Nowak, Morgan Stanley Managing Director. Big fan of his work and his team's work. Before I get to the Amazon robots, is there, just saying on Meta, is there a White House premium being built into the Meta multiple? Like, it doesn't hurt to be friends with the White House. And we've seen a dramatic shift in how Meta is viewed.
I don't think it's actually impacted the multiple in a material way. I would agree with you on the messaging and relational shift that's gone on, but I don't think that the multiple's expanded because of management's increased relationship with the executive branch. So, I still do think there is some uncertainty about what happens with TikTok. And where TikTok, if TikTok is acquired, who ends up acquiring it does matter for Meta. If TikTok is instead shut down, that also really does matter for Meta. That is sort of all related to President Trump as well, but I don't think there's a multiple premium necessarily related to their relationship change now versus the first administration.
Point well taken. All right, let's dive into this robots. I got this note. I wake up in the morning, I see this in my box. Robotics, retail advantages widening and the path to $10 billion of annual efficiencies for Amazon. That's the headline on your note right here. Very, very interesting stuff. I think people, when they think robots, they think humanoids that might look like me, might look like you. They're going to go in our house. But you really dove into what Amazon is doing in their distribution centers. Take us through that, because I read your note like, wow, I mean, there's a lot of cost savings coming out of Amazon, and that's why they're driving those op margin improvements in retail, finally.
Yeah, this is, I think, the most underappreciated part of the Amazon potential retail leverage to come. and Amazon as a stock being positioned as a Gen AI beneficiary. So some of the background here, Amazon has been building out robotics throughout their fulfillment centers, which are their warehouses, and all their sortation centers, which are sort of their last mile distribution network, really since 2012. So they've been doing this for over 10 years. They acquired a company named Kiva years ago. They've had some robots that are moving items around the warehouses, essentially mobile rack space. The developments that are new, though, are in the last 3 years, they've incorporated more machine vision, more large language model capabilities, and they now have 6 new robots that they're starting to integrate across their warehouse network.
That don't look like people.
They don't look like people.
Okay.
It's exactly right. They're not humanoid.
People.
They're not humanoids.
They don't look like Jeff Bezos.
No, they don't look like Jeff Bezos. No, they are robotic arms. They are more sophisticated robotic arms. They are robotic packaging machines that essentially use more machine vision to determine which package goes where. And they are large mainframe robots that essentially run all the conveyor belts and the distribution of the items throughout the warehouse. And they also do have the mobile racks that move around as well. So it essentially is taking a lot of the manual labor, in some cases some of the more dangerous parts of the warehouse process, and putting it in the hands of robotics.
Who wants to lift a 70-pound box?
Exactly, for 10 hours a day,
Yeah.
right? And so the exciting part about this is Amazon now has one fulfillment center in Shreveport, Louisiana, that they opened last September that fully incorporates all these new robotics. And what we've analyzed in the note is Amazon now has robotics that cover every aspect, almost every aspect of the fulfillment process in this warehouse. Taking the inventory in, moving the inventory to the correct racks, labeling it, picking it, packing it, moving it toward the package, and essentially moving it toward the outbound station. This first warehouse in Shreveport that's incorporating all of these new robotics is essentially seeing a 25% reduction in fulfillment cost per unit for Amazon.
Huge.
It's huge. You know, for perspective, fulfillment cost per unit, depending on the quarter and sort of the instance that we're talking about, it makes up 15 to 20% of revenue for Amazon's retail business. So when we think about the long-term sources of leverage in this model, the extent to which Amazon can go from one warehouse to a lot more the next 3, 4, 5 years, we think there's significant savings to come. You know, the math that we've run shows that every 10% of US units that Amazon can move through these next generation warehouse-enabled, robotics-enabled warehouses essentially probably saves them $2 to $3 billion of EBIT on a recurring basis. They can choose to either reinvest that in growth or flow through to cash flow. But when we're talking about the company in 2026 potentially generating $100 billion in the base and then going to 115, 120 in the out year, $2 to $3 billion, it does matter. So I think this robotics angle of how, you know, they are really on the knife's edge of using large language models in robots to essentially automate some of their most expensive parts of the business.
If I'm at Target, I gotta be terrified by this.
No, I
mean, this is a, I mean, not to talk like Amazon's book, but this is a major competitive advantage. It has to be for other retailers.
Major structural competitive advantage against other retailers, as well as everyone else that does warehousing and distribution. You know, because the other part of the goal for Amazon long term is they are trying to do more fulfillment and more distribution even for items that are not sold on Amazon. And so the extent to which that they can roll out more robotics, they can drive the costs down and essentially be even more competitive on rates for other sellers and smaller retailers to use their network. Because when we think about the investments they're making in fulfillment, and on robotics, that I would argue is stage one of where probably the 15 to 20 year vision on Amazon robotics and logistics heads. We have these fulfillment savings, which we talked about with these new robots. Then you have shipping and sortation centers, which are all the last mile stations, some of which are located even throughout Manhattan. That shipping and last mile sortation, that's another 15 to 20% of revenue. These are the two biggest costs, shipping and fulfillment. you could take robotics and also integrate those eventually into some of the last mile. Then we get to the trucking network. Amazon is already investing in autonomous trucks. They are already investing in autonomous cars through Zoox, and of course they're investing in drones. And so in totality, over the next 10 plus years, they're essentially investing in automation and next generation robotics to handle what ends up being 35 to 40% of their costs of every dollar that flows through the P&L. So for other retailers, I think there is going to be an impetus to press faster on investment, because Amazon is certainly pressing aggressively. To your point earlier on the $100+ billion of CapEx, most of that is AWS, about over 70 billion of that is AWS, but we do have the remainder of it going toward retail, which in part is funding this robotics expansion.
Wild. We have a minute left. I'd love to get your hot take on this. I recently met with Amazon CFO. I left that meeting thinking, I don't think they're going to challenge NVIDIA in making their own chips. About 40 seconds left. Do you think Amazon will challenge NVIDIA in making its own chips?
I think there's a possibility. I think that as we think over the next 3, 5, 10 years, and there are more use cases across the economy using smaller large language models for inference, there is a possibility that Amazon's Trainium and Inferentia chips, which are not as expensive, could actually have a higher ROI versus NVIDIA's offering. As of right now, we don't have any real upside in the model from that. But I think as we think over the next 10 years of diffusion and new use cases across the economy, I think it's reasonable to assume that there will be some smaller applications that the math may work to use more Amazon chips as opposed to use NVIDIA.
I think this conversation reminded me that my Prime bill is probably going to go up over the next 5 years. I mean, they're going to have to get more money from us. I mean, that's just the bottom line. If I could support their robot efforts, I'm okay with that.
Your utility will go up too, though.
Yeah, no, I appreciate it. Morgan Stanley's Brian Nowak, good to see you. Big fan of your research. Thanks for taking the time. Your office is right down the block. Hanging with us at the NASDAQ. We'll talk to you soon.
Thanks, Brian.
All right, that is it for the latest episode of Opening Bid. Continue to hit us with those likes on the major podcast platforms and YouTube. I read every single one of your comments because that's just what I do. We'll talk to you soon.